This is now being recorded.
Compared to C90, EBITDA margin of 11.7%, EBIT of 5.7%, and EBT of 4.8 reflect the strong business recovery in Q3 and Q4 quarters and the internal efficiency improvements. On page 16, we have the full year results of C20 for MCI Europe. There has been a 28% fall in sales vis-a-vis full year C19. EBITDA margin was at 7.6%, EBIT at 3%, and EBT at 2%. As mentioned in earlier calls, actions taken to adapt to the new market reality resulted in restructuring costs spread over CY 2020. On page 17, we have the C20 consolidated results of MCI, which are a combination of a disappointing first quarter, a lost second quarter, and resurgent third and fourth quarters. In C20, there was a 23% drop in sales. Despite a tough year, we reacted with alacrity and strongly to the changing market conditions and took measures that have put us in a stronger position to continue growing and improving. The EBITDA margin for the year is 9.6%, EBIT 4.3%, and EBT at 3.4%. On page 20, you will see our abridged consolidated balance sheet. The return ratios for the full year CY20 reflect the more than 20% drop in sales, but the effect of the measures that we have taken is shown by the prorated return ratios of Q4 C20. If we just consider Q4 C20, we achieved a RONA of about 10% and ROE of 9.1%. Our overall net debt has increased by about INR 1.2 billion to end at INR 12.75 billion, but this includes an increase of INR 2608 million due to changes in India's 16 accounting standards and INR 1512 million increase due to exchange rate impact. The cash flows are shown on page 21. Our cash generation has been strong, where we generated an operating cash flow of 51% of the EBITDA. There was a capex of INR 2761 million in C20 on a consolidated basis, which was slightly higher than what we had talked about previously, but was largely because of the more than expected resurgent demand in India. On page 24, we have laid out MCI's strategy. We have laid out the differentiating principles, business strategy, opportunities, and risks. We believe that exports from India is a huge opportunity and that digitalization of operations can push up our plant efficiencies. We are also keeping a keen eye on EV penetration across markets and reacting accordingly. On page 26, we have charted MCI's stock performance as compared to relevant indices and market cap. The next few pages talk about the market statistics and forecasts from relevant sources, followed by the results submitted to SEBI in the prescribed format. In conclusion, let us assure you that we continue to focus on growth, customer satisfaction, and leaner operations with more productive routines to deliver better operating results. This is consistent with our aim of generating better returns on both equity and capital employed in the coming years. So with that, I thank you for your time, and now we proceed to the Q&A. Back to you, Nishan.
Yeah, Malika, please.
Yes, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1 now. The first question is from the line of Bharat Seth from Quest Investment Advisors. Please go ahead.
Hi, thanks for the opportunity and congratulations, Ander and Vikas and team on good set of numbers. Hello.
Yeah, Bharat, go ahead.
So, Vikas, I'm just taking, in first part on the India part, you said that almost we have touched 1,000 crore quarterly run rate in this quarter, and we expect to grow, and EBITDA is 15% plus. So how do we really look at CY21, and what would be the concern in growing at this pace?
So, Bharat, Ander, please.
Yes, just from my side,
we expect to have a positive and strong calendar year 2021. Okay.
Correct.
What we know from the market is that we expect Indian market growing 23-24% this year compared to the 2020 that was clearly affected by the COVID. So we expect to see the market at the same level or even above 2019 market levels. Okay. So in that sense, what we expect is our business to continue performing well. At least in the last months, we saw a fantastic performance of the automotive market in India. The Q4 was really, really strong, thanks to the, let's say, good performance after the festive season. And this momentum is still there. Okay, so till now, what we can see is we are quite optimistic for the Indian market evolution in 2021, and we expect to continue improving our company results and margins.
So taking, forward, I say approximately 4,000 crore or kind of run rate. So, and this quarter we have hit, 15% plus EBITDA margin. So do you think this margin has picked out, or still there is a room to improve the margin from here? Or how do we see the impact of the raw material prices increasing? So overall, if you can give some color on the margins front.
Yeah. So yes, you properly mentioned that the raw materials are growing, that the prices are going up, and that can happen a slight effect in our margins in the short term. Then all the raw material prices are indexed with our customers, so we pass through the price increases to the customers. So in the long term, we don't see a big negative effect. Okay, apart from that mathematical effect that the raw material is a little bit higher, and so our turnover will be a little bit higher. But we think that this first target of 15% margin that we had for India, we already keep it. Now we expect to consolidate those margins, and in the future we have our internal target to reach the CIE margins that, as you know, we are approximately at 17-18% in global CIE margins. So we expect to hit those in the future. Okay, probably it will take time, but we expect to continue improving our internal efficiencies and with the volume effect that we expect to have, and with the consolidation that we are expecting to have in certain businesses. I think we will be able to continue improving our margins in the future.
And coming to enter on the Europe business, if you will compare, Euro term, in CY 18 we did 561 million kind of a run rate annual, whereas as per the CY 20 is roughly around 350 to 360, so which is almost say 40% decline. So how do we see now Europe business and margin? Vikas said that in Q4 there was a 1% impact because of restructuring. So how do we see the margin?
Okay, in Europe the situation is a little bit different than in India. As you know, we have one business with, let's say, lower performance than the other, our German forgings, where the margins are lower. So we accomplish a kind of downsizing of the business to consolidate the more profitable components.
Okay.
And the result of this reduction is that the size of the business in Europe is a little bit smaller than previously. This kind of a sign of this reduction is that our Indian business is now bigger than European one. In the past we were 60% in Europe and 40% in India. Right now we are 52% in India and 48% in Europe. Okay, so what we see is that
this German business will consolidate, or at least we, after the downsizing, we consolidate this business, and both CIE Automotive forgings in Europe and Metal Castello businesses are growing back again, okay? And the margins on these businesses are nice, are solid, and are improving. So overall, we see a kind of flat European business and a growing Indian business. That's the average of our evolution.
And I mean, when do we expect, I mean, to hit the run rate of CY18 when our revenue was around 560 million euro in Europe business? And last thing, on the semiconductor, if you can, any impact of this shortage of global semiconductor on our business?
Okay, we don't see the amount, let's say the size of the business that we had in 2018 in the near term in Europe. Okay, we see the market is far lower than those volumes that we had in Europe in 2018. Especially the commercial vehicles cycle is still far to reach those figures. So probably in the next 2 or 3 years we will not see those figures. And coming back to the semiconductor issue, it's true that there is a big noise in the market due to the lack of semiconductors in the automotive industry. We saw certain impact, but very, very limited. Okay, I think we saw 2, 3, 4% of impact due to this semiconductor issue. And as far as all our customers are saying us, they consider that this is a temporary impact and they will recuperate all these volumes during the second half of the year. Okay, so till now we saw a very, very limited impact in Europe. We had certain impact in India in the last quarter in 2020, but as you saw, the impact is not relevant. And till now, at least, we are not worried because of the impact of this semiconductor issue, because we think that this is a temporary subject that will be solved in the next months.
Okay, thank you. And if I have your question, I'll come back again to you. Thank you very much.
Thank you very much for your questions. Thank you.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi. First, clarification on this restructuring cost, which you indicated the 1 percentage point impact is in fourth quarter and in Europe, right?
Yeah, that's right.
And this would be pertaining to restructuring costs would be pertaining to reduction in headcount or something else?
Yeah, mainly it's reduction in headcount. Yeah, we are applying social plans. We are providing for headcount reduction, thinking that the volumes in the future will be low, especially in our German forging plants. Okay, so those are the restructuring costs that we accomplished. Also, we had certain restructuring costs in our Italian plant in Metal Castello, but all this, the plan is already finished, and we are already with the definitive amount of headcounts in those plants.
Got it. And second question pertains to the European business. What are the trends which we are seeing in Jan and Feb so far, and how are the production schedules looking for next couple of months, especially considering the second wave in Europe?
Okay, it's true that the automotive market, especially due to the impact of the pandemic, the third wave of the COVID-19 pandemic, the sales on the market are approximately 23% below January 2020. But the production from our customers and the demand is still quite strong. Okay, so we don't see this drop on the sales. And in the next months, what we see also in our forecasts from the customers is that the market continues quite strong and quite stable. So we think that there is an inventory correction probably going on in the market, and we think that the beginning of the year will be also in line with the last quarter and perhaps even a little bit stronger than Q4 2020.
Okay. So effectively, the forecast of IHS Global of about 15% growth in light vehicle sales, you fairly are comfortable with that kind of growth for CY21?
Yes. What we are, as you know, 2020 was a very complicated year, so taking 2020 as a reference is a complicated thing. So we prefer to compare against 2019, that was a standard year. And in Europe, what we will see 10% drop compared to 2019, something like that. I mean, between 10 to 5% less than 2019. And in India, what we expect is to have the same or perhaps a little bit bigger figures than 2019.
Okay. Third question pertains to primarily your commentary on adding 25 customers between 2019 and 20. So question here is, by when do you see the full ramp up with these customers? And what would be the contribution of these customers currently, and how do you see that going up in next 2 to 3 years?
Jinesh, as far as time taken, it takes about 18 to 24 months to start having an impact on the P&L. So that is what it will take. In terms of how much, I will, like we have talked about generic terms earlier, that new sales in a year, we expect that to be now 25% of a year's sale to come from new customers and products added. So which earlier used to be 15% in terms of internal target. So that is the kind of difference that we are trying to target. Otherwise, let me not speculate on the size of it. Yeah, Jinesh?
So your question is answered, Mr.
Yeah, sorry. One more last question on the ROE side. On the console side, for the fourth quarter, we indicated about 9.1% ROEs. What is our target for ROEs over next 3 years or so, and what would be the roadmap for attaining the same?
So in terms of ROE and RONA, RONA, which is more of an internal target for us. RONA, we are looking at reaching an RONA of 15%, and reach it as quickly as possible. In terms of roadmap, I think Ender answered that. The focus is on growing the India business. We expect the India business to grow quite well. Not just that the market is growing well. As we said, we have added customers, so we expect it to grow beyond the market. So the share of India business, which in Q4 crossed 50% for the first time, that will keep on increasing. The margins in India also, Ender indicated, we do expect it over a period of time to expand towards CIE margin. So this whole growth in India as well as the margin expansion in India is the main driver behind this increase in RONA. Of course, we are also looking at capex intensity in India and how we can make do with less capex in terms of all the the production efficiency programs that we are organizing. So in terms of roadmap, a large part of this expansion of RONA will be because of what is happening in the India business. As far as Europe is concerned, Ender answered that we are trying to stabilize that business. Maybe there will be very little growth on the European side, but we'll try and consolidate the margin so that so that would be the strategy. But the expansion in RONA will come mostly from the Indian business side.
Got it.
Yes,
got it.
Dinesh?
Thanks. I'm done. Thanks.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Sunil Kothari from Unique PMS. Please go ahead.
Thanks for opportunity, sir. Congratulations for good set of numbers. The general, my question is broad on understanding of looking at the Indian government giving the way support through PLI for manufacturing sector. We being a global player and very common that Indian units also can manufacture of a global quality. So any thought process in medium term, may not be near term, but medium term, to increase manufacturing base in India and reduce our this German maybe forging business or some very low return giving units from the Europe. Is there any possibility, any thought process like whenever since last 3-4 years we were increasing our exposure to India by acquisition also, like Aurangabad, this aluminium previously built forge. So larger thought process on shifting production base from Europe to India. Your thought process.
Thanks, Sunil. No, I'll answer first your question around PLI. Of course, we are also encouraged by PLI, even though the exact details of that scheme are not available. What we are assuming is whenever there's an export push, companies like us, and we are very much, we believe that we are very much on our journey to being world class. So therefore, we should be in a position to exploit that. But the details are not available as far as the PLI thing is concerned. Now, on your second question about shifting production from Europe to India, as we have indicated in the past, yes, we are considering that possibility. We have said in Meticastello, from Meticastello to India, it already has happened. There are other programs with other CIE companies also that we have been exploring both for forgings and gears. And we have also been exploring shift from our German forging business to India, depending on wherever it is feasible and the customer is okay with it. So it's not that we are not, when we talk about an export push, it does include some of these activities that we have talked about in the past.
So would you like to say numbers, because during last 3 years, how much we have shifted or how much it was exports to Indian manufacturing unit, and now how over the quantum, what type of progress or targets we are carrying for next 3 years? Any solid numbers which you can say?
No, let us, and I think again we have talked about it in the past, as in response to Dinesh's question around how are we looking at new customers, where we had mentioned that our target is to have new sales to revenue every year of 25%. Similarly, we are looking at increasing the export business. Export business from India currently is roughly around 11 or 12% if you look at the entire Indian business. And we are seeking to increase that over the medium term to 20%. So that is the kind of, just like on the order book, we have the other target on export, we have this kind of target that on a growing base of Indian business, and as Ander has indicated, the Indian business will grow much faster than the market as well as Europe. On that business, we hope to increase our exports from the existing 11 to 12% to about 20% through a variety of measures, including shift from some of Europe or tie up with some of the CIE companies in Europe, explore new customers in Europe, like for example, Forge and AEL. They have very strong European portfolio which has developed as new customers there. So that is when you say what is the target, this is the target to actually increase from roughly 11-12% to 20% over a growing base in the next few years. Okay. When I say next few years, we are talking about 3-4 years.
True. No, great. And first one more thing is, we were we were very confident about aluminum segment entering, and we entered this Aurangabad. And it seems that aluminum casting business will be giving you very good growth potential. So any your thought process or any further clarity on the possibilities and future prospects of this segment?
The aluminum segment, as I said,
Yes.
If you go back to the presentation that we have circulated at the time of the acquisition, that is somewhere around March 2019 or, around Q1 of 2019, if you look at, some of the things that we have talked about there in terms of exports growing, the size of the business growing, I think AEL is on track on delivering that. In fact, it is maybe, the goals have shifted just by a year or so because of that. But otherwise, the same numbers, the same roadmap that we talked about in that, I think, January or February 2019 presentation, exactly it has happened in a similar manner. So they have been doing very well. And we had talked about how they had increased the portfolio by looking at GDC exports in Europe. They had developed export customers in Europe. They were going very strong with the core customer in India. Of course, that cannot be neglected. One of the best OEMs that we serve, Bajaj. So it's an honor to be serving Bajaj. So they have done exactly as per that plan. So there has been, no deviation from that plan, except maybe you can talk about a 6 month here and there because of the COVID crisis. So they have been a very good addition to us in that.
Okay. So any major capex towards those segment, you feel that it can be a very major growing segment?
Which one?
Aluminum.
Yes, aluminum will be a strong growth segment. Therefore, I referred you to those numbers because if you remember, I think we had talked about a significant growth plan as far as AEL was concerned in that presentation. And I think it is as per that. If I'm not wrong, on an annualized basis, they were at 800 crores and they were talking about a significant expansion by, roughly 40 to 50% on a 5-year basis. I think that continues.
Great. Thank you. Thanks a lot, Vikas. Wish you good luck.
Thank you so much.
Thank you. The next question is from the line of Nemish Shah from MK Investment Managers. Please go ahead.
Yeah, thanks for this opportunity and congratulations on good set of numbers. In the recent union budget, there was an amendment with respect to depreciation on goodwill shall not be claimed as a deduction going forward. So just wanted to understand what impact will it have on our tax outgo and what will be our effective tax rate going forward?
JP, I'll take that. Hello.
Vikas, I'll take that.
Yeah, of course. You are the only one who understands this in any case.
I think everybody understands. Okay, so you're right. There is a proposal to deny depreciation on goodwill. So this will not have any impact on the P&L because we've been creating deferred tax liability for the reduction in current tax. So on the P&L, you will not see any difference. It will definitely have an impact on cash flow. We were saving a good amount, not paying any current tax, but we will have to going forward pay current tax. But as far as the tax percentage is concerned, we shouldn't see any difference. And we should maintain around 25-26% of average at control level.
Understood. Yeah, that's it from my side. Thank you.
Thank you. The next question is from the line of Nikhil Kale from Axis Capital. Please go ahead.
Yeah, thanks for taking my question. So my first question was on the new customer additions that you talked about in the India business. So while you highlighted the revenues that you're targeting from sales to these new customers and new products, would you please provide some more color on what technologies or end-use segments are these customers largely in? Also, when you talk about new products, what kind of growth in content per vehicle are we looking at going forward over the next, say, 2-3 years? If you could provide some color on
that. Thanks, Nikhil. The first question, in which segments we have added all segments. whether it is forgings, foundry, magnetics, composites, maybe not so much in stamping. Other than that, in every segment of India, we have added every segment of India. And that's the reason why we are confident about, the fact that India can grow much faster than what it has grown in the past. As far as your second question is concerned around content per vehicle, of course, we have not calculated in that fashion. For example, in forgings, we are going beyond crankshafts and metals. We are introducing new products. Say, for example, warm forging in Chatham that we are introducing. So I may not be able to answer on content per vehicle, but we are adding different kind of products in gears. For example, the BS6 gears are much more complicated than and what they were. In magnetic products, we are adding all kinds of newer grades, like higher grades. If you see in magnetics, it is the grades matter. So we are moving up in terms of more complicated grades. In foundry, for example, we are adding only machined orders. So, going forward, our endeavor, of course, is to have more than 50% of new orders in foundry coming, which is both machined and cast, and not just cast. And, we are creating a lot of capacity around machining and so on. So that is the kind of wave that we are going. Of course, on AEL, we have already explained in a previous question that AEL is focusing on GTC exports, customers in Europe, as well as on their core customer in India, which is doing very, very well. And therefore, we are expanding with them. Wilforge, we had already talked about earlier in terms of the kind of plans they had with exports and customers in India. In fact, Wilforge and AEL, the good thing is, if you go back to our presentations that we had made at the time of the acquisition, most of the plans in terms of new orders that we talked about there have happened. So, and that is something that we would like to emphasize. So whatever we had envisaged at that time has actually happened. So there is a strong order book there. So to answer your question, content per vehicle, frankly, we have not made that kind of calculation, but everywhere we are trying to move into what you would say better margin orders, whether it is machined castings or higher grade magnets or more complex gears, or even in forging different kinds of product categories. So, that's how we are doing things. So content per vehicle, I may not be able to answer you that question, but we can confidently say that, we are moving towards more complex orders.
Okay, thanks. And secondly, on the Europe side, just wanted to check, are we done with all the restructuring activities that we're looking at, or are there still some activities that to do which can maybe lead to some restructuring costs next year, in this year as well, in CY21?
Okay. Regarding restructuring activity in Europe, we provided during Q4 and during all 2020 last quarters, we provided all the costs that we expect in the next 2-3 quarters. Okay, so till now we don't have any additional restructuring costs on mind. So we consider that at least in the next month we will not have any additional restructuring cost.
Okay. Then would it be fair to assume that, considering that we've already hit a very good margin level, even for Q4, if I look at the margins, very good margins as per se. So going forward, assuming that once the corona kind of next wave dies down and the industry recovers over the next 2 to 3 years, and assuming that we are not really ramping up the MFE business a lot, the margin should remain stable or maybe slightly improve going forward, given that the mix improves and even assuming that the top line grows at a stable low or mid single digit rate.
Yeah, what we expect is that unfortunately in Europe the market will not boom in the next years. I mean the expectation is we will recuperate partially the drop of 2020, and in the next years we will see a slight recuperation, a slight recovery in Europe, but it will take 2 or 3 years to get back to the 2018, 2019 volumes. Okay, so and this is regarding the volume, and also you need to take it out that we have our German 14 downsizing activity, so the volumes will remain approximately flat. And coming back to the margins, what we expect is to keep or either to improve our margin despite these flat volumes. We expect to continue improving our margins thanks to our efficiency improvement activities and also to the different restructuring activities that we already did.
Okay, thanks. And lastly, just what is the kind of CapEx that we're looking at for this year?
JP, right? CapEx for CY21, any indication about same as 5 to 6% of sales or like?
The CapEx, you mean?
Yeah, CapEx for CY21.
Yes, the CapEx we expect to be at between 5 to 6% of our turnover. That is the standard. In 2020, we were at a little bit less than 5% because it was a special year. But in the last 2 quarters, as you can see, we recuperated the standard investment levels, and we expect to be at this 5 to 6% of capex in 2021. We can be close to 4 billion rupees.
Okay, thank you.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Vasudev Banerjee from Ambit Capital. Please go ahead.
Yeah, thanks, sir. Just continuing with the previous question, was trying to understand with your revenue margin recovering back significantly, when one should think that breaking the jinx from 5% of revenue as capex and look forward towards expansion and M&As.
Vasudev, if I understand your question correctly, you are saying, do we propose to increase our capex beyond 5 to 6% in case there is growth opportunity, right? And second question is around what are we doing around M&A?
So, to take it in a different way, that typically where conservatism towards capex and M&A, where outlook on EBITDA or cash flows was weak, that's why one remains conservative. Now with your numbers going back to normalcy, is there any possibility of a sudden increase in the capex outlook with sustainability of such good numbers?
Okay, so the question is, will we venture to increase our capex intensity beyond 5 to 6% of sales if demand requires? So that is the first question. And are we looking at M&A? So I will quickly answer, and then Ander can add to it. 5 to 6% of sales is on a consolidated basis. So as we have been saying, the growth opportunity that we see is largely in India. So therefore, the intensity in India is higher. It goes without saying. So we are looking, as we mentioned also in our transcript in Q4, there have been some capex addition. We talked about the number that is slightly higher than what we have projected, largely because we have been investing in India. So in India, that number is anyway highest because we are chasing greater growth in India. And overall, it comes to around 5 to 6%. Can we go further ahead than 5 to 6% if required in India? Yes, we will. If there is an opportunity, but we would like to hold the capex intensity in a manner that it doesn't affect our RONA. As I said, one of the levers to increase the RONA is to look at the capex intensity very carefully. Therefore, every capex is evaluated very, very closely. That is number one. Number two, on M&A, as I said, M&A is an ongoing activity. We keep looking at it. Only if it fills any strategic gaps that we have, we will look at M&A. We will not look at M&A purely to fulfill any growth aspiration. I think we have enough opportunities to grow organically. So growth aspirations is not what is driving M&A. M&A is driven by our need to fill strategic gaps. And wherever we get such an opportunity, we'll keep looking at it. So with that, I'll ask Ander to add on these two issues.
No, I fully agree with your comments, Vikas, and perhaps just to reinforce the message that yes, now after the normalcy, it's now in our business with the proper margins and proper cash flow generation after COVID crisis. But I think that yes, we are ready to continue our growth strategy. So yes, we are open for M&A activities and to continue developing our business in India. And regarding the capex, those 5 to 6%, this is a rule that we use because we want to keep all the financials under control. But it's true that if we see proper growth business with the proper return on investment, yes, we will accomplish it. Okay, so our growth strategy remains intact, and we want to come back to the growth that we showed some years ago, and we expect to be there soon. Thank you.
Sure. Second thing, sir, if I look at your consolidated minus standalone numbers, your interest outgo ex of standalone seems to have declined substantially, whereas interest outgo for standalone has increased substantially. So if you can highlight why is this significant reduction in ex standalone interest, any major debt reduction happened this quarter, or how to look at it?
JP?
Yeah, so the reduction that you see in India segment on the financial expenses in this quarter, particularly is because of some exchange gain in Mexico. Otherwise, over the year, it has been coming down. Vis-a-vis 2019, of course, it's come down because we acquired AEL. There was some income in last 2019, but in Q4, it is more particularly with the exchange gain.
Surely. So one should not look at this sudden major decline as a...
No. I think you should see it like over the year how it is coming down.
Sure. And last question, sir. If I look at your gross margin as such, so it has improved sequentially. So from your business model perspective, how to look at the inflation of raw materials? It must be a pass-through to end customers. But how is the contracts changing? How's the lag time with the raw material volatility, if you can highlight?
JP, will you take that? Raw material.
I think on raw material, we have a pass-through. If your question is if it is going up, how it impacts our margin, it has a marginal impact because of the denominator, because of the mathematics that Andrew mentioned. Other than that, we have a 100% pass-through.
And how should one infer the improving trajectory purely because of product mix and cost management initiatives? That's how one should look at it?
Yes, it's a mixture of course, efficiency improvement programs, break-even, focus on break-even reduction, and a little bit of product mix. And as we talked about, we are looking at more value-added orders. So yes, it's a mixture of these things.
Sure. And last question, as you highlighted, 100 bips of restructuring expense in Europe in this quarter numbers. I missed out. Did you mention how long that will continue, or is it just this quarter phenomenon?
I think Andrew mentioned in a previous question that right now we are not looking at anything more. This whole restructuring was spread over the year, not just in Q4. It was spread over the year, and it was both at Germany and Italy. But as of now, we are not looking at any more, especially in Italy. Of course, Germany is a bit more tricky, but as of now, we are not looking at more restrictions. Andrew, if you have anything more to add to this.
No, that's correct. I mean, we made all the provisioning during 2020. and now we are executing the plan, but all the costs are already provisioned. And now we don't expect any further additional restructuring cost provisioning in the next quarters. Okay, so we will see how the market develops and how the market behaves, and then we will decide, but not in the next couple of quarters.
That's good, sir. All the best. Thanks.
Thanks,
Thank you very much.
Thank you. The next question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Yeah, good afternoon. Thanks, team. Thanks for taking my question. My question is to Ander. Ander, in Europe, we have announced that we will venture into aluminum forging to de-risk our portfolio from the electric vehicle penetration that's happening now. Just trying to understand there, our parent CIE also has this HPDC aluminum casting per se. If you can just give some examples of what are the use cases for aluminum forging in the EV, and how does it vary vis-a-vis the aluminum casting use cases from an electric vehicle perspective? Thank you.
Okay. What we are now trying to do is to diversify our product portfolio, reducing our dependence on in certain plants on the engine components, okay, in the internal combustion engine components. And this strategy, one of the possibilities of this strategy is to go to the aluminum forging components. I mean, that in the automotive industry right now, the introduction of aluminum due to the weight reduction requirements in the cars is very important. Okay, so we have different technologies in the aluminum. You can have the high pressure die casting aluminum, like that what we produce in IL, for example. This is high pressure die casting. We have also gravity that we have in our AL plant, and then you can have the low pressure and other technologies that we don't have in CIE. Okay. And regarding this aluminum forging, this is a very specific technology that we are now developing, and it's mainly to produce suspension and chassis components for the automotive industry that can be used in the battery electric vehicles or in the internal combustion vehicles. All this technology, what is opening us, together with other components that we are also developing, steel chassis components in our forgings. So what we try is to reduce and to have an offset the potential drop that we can have in the future in Europe due to the battery electric vehicles growth. However, just as a comment, I mean, the expectation of having pure battery electric vehicles in Europe is approximately in 2025 about 15%, and the impact that we could have in our total Mahindra CIE European business is less than 5% of the total turnover. Okay, so we have more than 5 times to find solutions and to look for alternatives to offset a little bit this potential drop. So that's the explanation of all this strategy.
Yeah, thanks, Ander. And just to clarify here a little bit more, so aluminum forging will be used largely for the load-bearing parts, is it, as opposed to casting, which are used for the all other parts per se? Just from a use case perspective, trying to understand the application or the use case of forging, yes, aluminum forging.
Okay, the aluminum forging, the forging technology gives the much higher mechanical properties than the cast aluminum. Okay, the cast aluminum has not not big mechanical requirements. So for when the part is has important loads or big loads, like in the suspension or in the chassis components, then the aluminum forging is a potential good solution. Okay, so that's the application. From the application point of view, the forging is mainly in the chassis and suspension products.
Understood. Yeah. Thanks, Andrew. Thank you very much.
Thank you.
Thanks, Shyam. Thanks for your question.
The next question is from the line of Bharat Seth from Quest Investment Advisors. Please go ahead.
Hi, thanks for the opportunity once again. Now, and this question is for Ender. I mean, Ender, of course, as you rightly said, that to reach, CY 18-19 number will take few years. But we are currently in last quarter, we have already clocked around 100 million turnover. So do we expect that this kind of a run rate will be able to maintain, subject to some seasonality, or in the CY 21, and from there a kind of a mid-single digit to high single digit kind of a growth in CY 21 and CY 22?
Okay. We see we have a mix of different behaviors in the different businesses that we have in Europe. Okay, and in CIE, let's say in the passenger forgings and in the metal cast gear business, we see the growth, and we will recover in a couple of years. We will recover the 2018-19 figures. That's our expectation. Okay, so we expect to recuperate those volumes in the next 2-3 years. But coming back to German forgings, in Germany we don't expect to grow. We continue with our downsizing activity. That's why the balance will be a kind of flat or a slight growth expectation. And of course, it will depend on the commercial vehicle market cycle. You know that we had the peak of the cycle in 2018-19, beginning of 19. Then we start the let's say the downtrend on the commercial vehicle cycle, and we expect to start growing again in the next month. So let's see. But if the market goes up, we will probably recuperate and show some growth. Otherwise, we can see a kind of flat evolution.
And how confident are we, to sustain, this Q4, adding after removing restructuring cost, our EBITDA margin is around 13%. So, this sustaining that margin?
Yes. We expect to be able to sustain and to keep these margins, and even of our internal strategies to continue improving those margins. Okay, so that's clear from our side. So we, at least if the market behaves as it is, as we expect in the next quarters, we will be able to keep or even to slightly improve these margins.
And currently, how much PV contributing? So EV contributing to European business top line?
Our European business top line, or like overall industry are we talking?
No, I'm talking of European only entity.
No, but are we talking about the contribution of electric vehicles to the European industry, or to MCI Europe?
MCI Europe.
Okay, MCI Europe.
The impact is very, very small in this moment. You need to think that the total the battery electric vehicles share in Europe is now approximately 5%, and we can have as we have the off-highway or earth-moving activities, commercial vehicle activities, where the introduction of the battery electric vehicle is very, very poor. We have, I don't know, can be 1% or less than 1% of the share that we can have in battery electric vehicles. Not relevant.
And because in Indian operation, you stated that in each of our main business, whether aluminum, forging or casting, we will look for more machine product. So currently, what level we are, in aluminum, forging as well as casting, our machine product contribution, and where do we really see from here on, over next 2-3 year time?
No. When I talked about machining, it was specifically related to casting, our casting business, our foundry business. In other areas, as you would be aware, Billforge anyway is very high on machining. I think almost 75 to 80% of their products are cast. Only the races and retainers that they do for two-wheelers are not machined. So Billforge anyway is very high. At our other forging business, I think because we are in crankshaft, so whichever customer asks for machine crankshafts, we give. Most customers don't ask for that. So they're in the range of about 20-25%. But as I told you, in the forging business, we're looking beyond crankshafts and knuckles, which have been our mainstay for some time. So the strategy there is, of course, machining. We are strong in machining there, but the strategy is to move beyond crankshafts and knuckles in that forging business. So that machining part was specifically for our castings business, where we are focusing on machining as a strategy.
So beyond, crankshaft and so other new product, are we really developing for, in this casting side, foundry business?
Foundry, yes. Foundry, as I told you, most of the new orders are machined casting orders.
And that is which component? If you can give some color.
They have a range of components, so they have a lot of different kind of housings, etc. That they have. Except, they have the cast crankshaft. Except for that, in most other components, there is ample opportunity for machining.
And is this PV side or CV side of the business?
It is a mix. It's a mix. As you know, the casting business is very, very diversified. So it's from tractors, light vehicles, heavy vehicles. They supply a whole lot of products.
Okay. And would you like to give some color on what is happening on the Mexico plant?
Billforge Mexico. And the Billforge Mexico update.
Oh. Yes. Okay. Mexican plant is performing very well in the last months. We have implemented, let's say, a lot of cost improvement activities and efficiency activities. Our delivery ratios to the customers and the quality results has improved dramatically, and the growth expectations are, let's say, very important. Then what we are now launching and developing, I think, approximately 15 different part numbers that will be launched in the next 12 months, and the growth expectations and the results expectations of the company are relevant. Okay, so we are very happy with the development of the business. It took some time to get the proper knowledge and to train the team and to make all the technology transfer. That was some tough period, but in this moment the company is, let's say, growing. We have 2 big programs with 2 big customers coming in the next months, so we will see a growth history in Mexico soon.
And are we making EBITDA break-even full year or quarterly, or if you and when do we expect, if we are not on margin perspective?
Yeah, in the EBITDA margins, we are already at double-digit EBITDA margins, and we expect to have our internal target is to be approximately at our Indian margin levels in the next year. Let's say during the next year we will be able to reach those margins. That's the expectation.
Okay. Thanks a lot. Thanks and all the best, Ender and Vikas and Jay.
Okay.
JK, Jaideep.
Thank you very much. Thank you.
Thanks, Bharat.
Thanks.
Thank you. The next question is from the line of Nikhil Kale from Axis Capital. Please go ahead.
Yeah, thanks for giving me the opportunity again. Just one question, which is on the NFC business. So, very clearly, I mean, we are not really seeing a lot of growth happening there. Even if it happens, we are not really keen on expanding the business. The margins are low. So, just wanted to understand what is the long-term strategy, or how are you looking at this business? Because very clearly, from an overall perspective, this business will be pulling down our return ratios. So, what's the strategy for this business going forward from a long-term perspective?
Okay, so the strategy regarding Germany is to, let's say, continue with the downsizing of the company, trying to obtain the minimum margins to keep them in the future. Okay, so what we have been struggling in the last years due to the different cost impacts in the labor cost increase, also with the energy cost increase, and finally the drop of the market creates some difficulties on our business. However, we continue working very hard in order to reach at least the minimum margin so we can survive. So the decision was to reduce the loss-making products, eliminate all these lower margin products, and keep the most profitable product portfolio for the future. So the idea is to make an organized reduction of the activity and try to improve the margins after all the restructuration job that we have done.
Okay, and what would be you talked about minimum margin level. So what would be that internal target at or above which it makes to kind of continue that business? Any internal targets that you're looking at?
Yeah, we already talked in different calls that we were expecting to reach the double-digit margin. That is our internal margin, so that can give us the positive EBT with relatively, let's say, with a positive cash generation unit. Okay, that's the target that we have, and that's why we are fighting and trying to get those targets.
Okay, thank you.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Okay. So I would just like to thank you to all the participants for the questions, very clever and interesting questions. And I would like to say that the company, after a very difficult 2020, we did our job. We work very hard. I'm really proud of the evolution and the work of the management in these difficult times. We show our flexibility and our resilience to let's say, continue developing this business, reaching again the margins that we were expecting, and I think that we will have a bright future in front of us. So I would like to thank to my team for the fantastic job, and I hope you will trust on us in the future also. Thank you.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Yeah. Thank you, everyone. Have a good day.
Thank you. Goodbye.